doing well. This is Shourabh Bhattacharjee and I welcome you to my channel Trading IQ, where I'm sharing my journey as a retail trader. And my goal is to be a successful trader and investor in the stock market. I'm nowhere being a successful trader or investor yet. I'm on my journey. Thus, I've created this channel to share with you guys the whole journey from scratch, so you can understand, because most of you are retail traders. So whoever I'm targeting, like through these videos, are retail traders, because I know the pain, because I have been feeling the pain of a retail trader, how it is to be losing money consistently, and how I need to turn things around to make a consistent profit. And I want you to be a part of this journey, and thus I'm making these videos because it's informative, because I have invested my time, so much time to study, to learn how stock market works, how the prices moves, how option market works. I've given so many hours to this, and I'm motivated, right? It's sort of my passion, and I had quit addiction because of stock market, because to form my psychology in such a way that it is always positive and it is fearless, right? So I'm also working on my psychology. That is the most important aspect if you are to make a consistent profit. So I'm working on my psychology, and at the same time I wanted to give you guys these informative videos on different aspect of, because see, at the end of the day you have to learn the technicality of different things to understand the concept, right? Without the concept, with psychology, you cannot do anything, right? Now I'm doing the series on option trading, wherein I have created a couple of videos, one of them being the general idea of how option market works, and another one, the last video, was on the moneyness of the contract. So those two are very essential video if you're willing to learn option trading, how option market works. And in today's video, I'm going to discuss about a very important topic, that is volatility. Now, this is a very less focused topic among retail traders. Like, we all know the term volatility. We all have used it in different contexts. Like when we go to the vegetables market, the prices of different commodities are continuously fluctuating, and we tell to ourselves that the prices are so volatile. So volatility means it means fluctuation, right? And we see fluctuation in all different things in life. So we all know the term volatility, but then when it comes to stock market, we interpret volatility in a very wrong way. So I'm going to discuss on this topic. This is a very vast topic, and I cannot cover everything in one single video, so I'm going to take another video or another couple of videos. But I wanted to share this with you guys, because when you make a decision on whether to do whatever, like in the stock market, to buy, sell, create strategies in option, volatility has to be the core point of attention when you do anything, because volatility is movement. So anyways, I'll go into the details in this video, so I would request you to please watch till the end, and whoever is willing to learn option trading, this is very essential for you. There is no alternative but to learn volatility if you are to make consistent profits from option market. And if you are an investor, if you're dealing with cash market, it is also very important for you to understand, because if you are only looking to invest for, say, a certain period of time, you need to check how volatile the stock might be in that period of time when you want to invest, for how long you want to invest. So it is also very essential for investor to understand what is volatility. So let's jump into my screen. I'm going to use an example that is already there, and it is on Zerodha Varsity. I'm going to take you there and share a very easy example, a very simple concept to understand what is volatility. So this is Zerodha Varsity, and of course I'm not going to discuss all this. I'll just be focusing on volatility, and I'm going to cover the other parts also on my channel. By the way, this is a very important thing that Zerodha has provided to all newbies. Like I studied all the chapters here from Varsity last year, and I went through multiple times, especially the volatility part. So it took me time to understand the concept. So I'd given time to understand how these things work. So that's why I'm teaching you guys, because I now know the concept. So yeah, of course I mean, I would highly recommend you guys to please go through these articles, like, you know, all these chapters at Zero Diversity. I'll put the link on the description of this video. So let's understand volatility. Okay, I'll not be reading through these because it's a, you know, very long example. I'll just make it short and crispy. Okay, so we all love cricket, right? We are Indian and we love cricket. So there is two batsmen, and we have stat for both of the batsmen, and for the last 6 matches. And let's suppose you are the team captain and you want to pick one of the batsmen, and you want that batsman to score at least 20 runs, right? Now you have the stat for all so for both the batsmen, and so the name of the batsmen are Billy and Mike, and these are the scores that you know, both Billy and Mike scored for the last 6 matches. So Billy scored 20, 23, 21, 24, 19, 23, so close to 20 all the times, and Mike scored 45, 13, 18, then again 26, 19. So let's do an average. So I'll not do anything because it has all been done here on Zero Diversity. So I'll not do anything. I'll just, you know, walk you through with a simplistic way. So the average, like Billy's average is 21.61 and Mike's average is 22.16. Now our agenda is that whoever you pick has to score 20. Now you see the average of Billy is 21.67 and Mike's is 22.16. Now who is better? Who would you pick? Would you be able to come to a conclusion that Mike is better because his average is higher than Billy? No, because your goal is to have someone as a player who can score sort of guaranteed 20. I mean, no one can guarantee anything, but at least close to 20. Like, the probability has to be higher. Why would you not pick Mike? It is because of volatility. Now, how it is to be calculated? Please don't look at the complexities of calculations. You just have to know this is how it is being calculated. How it is being calculated, you should not bother much. You should only bother about the data versus how you're getting the data. Okay? So here, Billy's average is 21.67. Okay? So here, this line that you see here, this is Billy's average. Now we would see like each observation, which are like 20, he scored 20 on the first match, then 23, 21. So we would see the fluctuation from its average, right? So the first match, the fluctuation was about 1.67 less. He scored 1.67 than his average. On the next match, he scored 1.33 more than his average. So this is how the whole thing has been structured, right? Now, if we are to calculate the average fluctuation, these are the fluctuation that you see. Now you have to find out the average of these fluctuation, and for which there is a simple calculation that is available to each one of us. I will share on this video itself. Now here it is calculated by squaring of each of the differences, and then sum it up and then divided by the number of observation, which is called variance, and then square root of variance is standard deviation. And this is how we got the standard deviation of Billy is 1.79. I will do it for, we'll pick one of the stocks and we'll find out volatility, and we will calculate on an Excel sheet and using a standard deviation formula. So don't worry about it. I'm going to do that. So again, don't put focus on the formula or the equation. Just focus on the output. Okay. So here, this is the standard deviation, 1.79. Similarly, if we calculate my standard deviation, it has not been done here. Like the calculation has been done. So it would be 11.1. Okay. Now, this is the average standard deviation, like average fluctuation. This is called standard deviation. The average fluctuation is the standard deviation. So for Billy, it is 1.79, and for Mike it is 11.18. Now Billy's average is 21.6 and Mike's average is 22.16. Now on the next match, Billy has the higher probability of scoring close to 20 because Mike can either score 22 plus 11, which is a standard deviation, 33, or 22 minus 11, because fluctuation means up and down. It can either be above the mean, the average, or below the mean, right? So Mike is volatile. Mike's nature of scoring is very volatile. Like, we have so many players in the Indian cricket team, like whose numbers are so volatile. Someday they score 100, and for the next couple of matches they score zeros and twos, but then the average score is sort of on the 40s or 50s. But then you know what I mean, right? The fluctuation, like, you cannot depend on that guy that he would score 50 just because of his average. You have to see his standard deviation. So these are all being calculated when it comes to cricket. So just that's why there is an analyst sitting on each of the for each of the team. There is an analyst, right? So this is how you would calculate standard deviation. Now, if you had to pick any one of them from Billy or Mike, who would you pick? Billy, because he has the higher probability of scoring 20 or close to 20, because nothing is guaranteed, but at least he has the higher probability. And Mike has the probability either to score more than 20, like a 33, or 11. Like, if he does not score, the team will suffer and will suffer big time, because he's only giving you 11 and you need 20. So of course there is a risk with Mike. So with different stocks which are very volatile, there is risk included, and then of course the reward is higher with higher volatile stocks like mine. Now let us calculate volatility of any stock. Let's find out the annual volatility of Infosys, right? So this is NSE website. So let's suppose let me type Infi, because that's the code name of Infosys, and I'll try to find the last 1 year's data. So I'll try it from June, 1st June, and then May 30th. So you see, this is the whole data. Okay, I'll just download this file into an Excel. I'll open this Excel. Now here I don't need anything, but I would need the closing price of each day. Okay, I'll just remove everything else. Okay, now here I will find the daily return by ln, means log returns. So I divide the today's, like the previous days, by the previous to previous days price, and then I'll find the log returns, and then this is it, and I'll just multiply into 100 to get a percentage. So this is the percentage. I'll just drag this around, and the formula would implement for other feeds. Now I'll just simply do standard deviation, for which this is the formula STDEV. Okay, and then I'll just calculate for all the daily returns that I've just found out, and here it is. Now this is the daily volume, the average fluctuation. The daily average fluctuation is 1.57. Okay, so daily you can expect the stock to fluctuate anywhere between 1 to 1.57%. Now let's look at what is the price of Infosys right now, which is 1526. So the daily fluctuation is 1.57%. So we will find out what is the daily. So the Infosys price could fluctuate anywhere between 23 points upwards or downwards, right? Daily. Now if you are to find, say, let's suppose you want to invest on Infosys for say 2 months, right? So 2 months means you have to find out how many trading days. So generally Monday to Friday, 2 months means 20, 20, 40 days, like let's suppose 40 trading days. So to calculate the volatility for a given period of time, you just need to do one thing. So here is the formula. You would multiply this output, the daily volume, into square root of the period of time, whatever the period of time you want to invest in and you want to check the volatility for. Let's suppose 40. So 9.94%. So 15.26 into 9.948% means 151. So Infosys in the next 40 days could fluctuate between 150 points upwards or downwards. So this is how. Now this is what we call, this is the historical volatility. Now historical volatility, it's always it is an annualized number, right? So the daily volatility is 1.57. So what is the annual volatility? Again, I'll just multiply this into the square root of the number of trading days in a year, which is 252. There are 250 trading days in a year. So the annual volatility of Infosys is 24.96. And this is what we call historical volatility. And this is for which are the period that we have used to calculate this and historical volatility. It's for 1 year. So the general of the basic, the common stat or the data that everyone looks at is 30 days volatility. So what you would have to do, you just have to pick the last 30 days. Okay, let me do that for you. Let's suppose here, I'll just take it here and I'll take it somewhere else. Here, these are the 30 days. Okay, yeah, it already has the logarithm, so I just copied and pasted. Now I'll just do the standard deviation. 2.53. Okay, now if I have to get the analyzed number, I just have to do the same, square root of 252. So for 30 days historical volatility is 40. Okay, and annual is, if we take the period of last 1 year, the annual volatility is 28, and for 30 days historical volatility is 40. Of course, we have seen higher movements in the last 30 days compared to the overall year, the last year. So that is how you would calculate historical volatility. So it is available to you. You don't need to look anywhere. You just go to NSE website and you find all the data. You can find data of, say, Reliance. I'll just get the data of Reliance. So you can find the data from NSE website and you can calculate the volatility based on the number of days or the period you want to invest your money. Implied volatility is something that the market is predicting what the future volatility will be, and here market can be wrong, and it happens that more than often market is wrong, because market estimates future volatility based on so many different factors. So let's suppose there was this war with Russia and Ukraine, and the volatility went up like crazy, because when market is sensing something, when market is expecting something, the volatility tends to go up higher. And when there is no news, when there is no expectation, implied volatility would go down. So implied volatility is sort of an emotional quotient. Like, you can check what's the market emotion by the implied volatility. So I'm going to discuss in detail what is implied volatility on my next video. So I would request you to please like this video, subscribe to my channel, and please hit the bell icon, so when I publish the next video, you get a notification. And the next video will be very interesting because I will use some real life example to help you understand what is implied volatility, and it is very fascinating. When I was very fascinated when I got to learn the basic idea of implied volatility and how you can use it for your benefit in the option market. So I hope you like this video, and I'll see you guys on my next video. Thank you. Have a